Inflation is a word we hear all the time. It's mentioned in the news, discussed by politicians, and felt every time we go shopping. But what exactly is inflation and why does it matter? The simplest way to think about inflation is this. Inflation is the gradual increase in the prices of goods and services over time. When prices rise, each dollar buys a little less than it did before. In other words, your money loses some of its purchasing power. Imagine stopping by your favorite coffee shop. A few years ago, your favorite drink might have cost $3, but today that same drink could cost $5 or more. The coffee didn't necessarily become twice as good, but the price increased over time. That is inflation. It can affect groceries, gasoline, rent, electricity, insurance, clothing, and thousands of other products and services people buy every day. So why do prices go up? Inflation usually happens because of several factors working together. Let's look at 3 of the most common reasons prices rise. One common cause is when more money begins circulating throughout the economy. If more people have money to spend, but the amount of goods stays the same, prices often begin to rise because more people are competing for the same goods. Another cause is higher business costs. If it becomes more expensive to produce products or transport them across the country, businesses often raise prices to help cover those additional expenses. Supply shortages can also create inflation. If fewer products are available while many people still want to buy them, competition for those limited goods can push prices higher. Here's a simple example. Imagine a small town with 100 apples for sale. Each apple costs $1 and everyone is happy paying that price. Now imagine everyone in town suddenly has twice as much money to spend, but there are still only 100 apples available. More people can afford to buy apples, but there are no additional apples to sell, and because demand has increased while supply has stayed the same, the price of the apples begins to rise. The apples themselves haven't changed. What changed was the balance between the amount of money people had and the number of apples available. Many people think inflation is caused by businesses charging higher prices, but the reality is usually much more complicated. Inflation often results from a combination of increased demand, higher production costs, supply shortages, and changes throughout the economy. It's also important to understand that not all inflation is considered bad. Most modern economies experience a small amount of inflation each year. A modest level of inflation can encourage people to spend, invest, and grow businesses instead of keeping all of their money sitting idle. The problem comes when inflation rises too quickly. Rapid inflation can make everyday life more difficult because prices increase faster than many people's incomes. Families may find it harder to afford groceries, fuel, housing, and other necessities. Savings can also lose purchasing power over time if they don't grow as quickly as prices do. Inflation doesn't mean every price goes up at the same time or by the same amount. Instead, over long periods, inflation generally means the overall cost of living rises. This is why inflation matters to everyone, whether you invest in the stock market or simply buy groceries each week. Understanding inflation helps explain why prices change over time and why the same amount of money doesn't always buy the same amount of goods. In our next lesson, we'll explore purchasing power and learn why the buying power of your money changes over time. If you found this video helpful, please like, share, and subscribe to Life and Money for more practical, beginner-friendly lessons about money, investing, and the economy. Thank you for watching.